Hey, Steve Jolly with the Home Buying Skills Channel. On today's show, we're going to take a deep dive in the world of out-of-state real estate investing. So if you're considering buying or selling real estate in the next year, this video is for you. We'll be discussing how to invest in real estate out of state, the questions you should ask, the areas you should consider. So grab your favorite beverage, get comfortable, and let's get to business. Let's answer the question first, why out-of-state investing? And as we've mentioned in previous videos, people often reach out to us with questions about investing in real estate outside of their local market. And the main reason behind this is the high cost of investing in their local market, which leads them to look to more affordable areas. For example, if you're in a state like California, New York, Illinois, you'll find that it's much more expensive to invest in real estate than in other states like Tennessee, Florida, Georgia, Alabama. And by investing out of state, you can potentially buy multiple properties with the same amount of money you would be spending in your local market. Let's talk a little bit about cash flow versus appreciation, because that's so important. Before diving into out-of-state investing, it's crucial to understand your investment goals. Are you investing for cash flow or appreciation? It's often challenging to find a property that offers both. For instance, states like California offer long-term appreciation, but the barrier to entry is higher due to the required down payment. And on the other hand, investing cash flow often means looking for opportunities in more affordable markets where the rent exceeds the mortgage payment. So be clear about your investment goals before venturing out of state. Let's talk a little bit about the pros and cons about out-of-state investing. So investing out of state has its pros and cons, and the main advantages include lower upfront cost, higher cash flow, and the potential for growth in emerging markets. However, the downside is that many of these markets may not appreciate as much more expensive markets like California or New York. And it's essential to weigh the pros and cons before deciding if out-of-state investing is the right path for you. Section 4, finding the right markets. When it comes to out-of-state investing, finding the right market is crucial. You'll want to look for markets with affordable properties, good cash flow potential, and promising economic indicators such as job growth, new businesses, or population growth. Some popular markets to consider include Texas, Tennessee, and Florida. But it's essential to do your research to find a market that aligns with your investment goals. Let's talk about building your team. A crucial aspect of successful out-of-state investing is building a reliable team of professionals to help you along the way. Now, this includes a local real estate agent who understands the market, a property management company handling the day-to-day operations, and various craftsmen and tradespeople for repairs and maintenance on your property. Your team will be your eyes and ears on the ground, helping you make informed decisions and keeping your investment running smoothly. Due diligence is also important. And before researching a property out of state, it's essential to conduct a thorough due diligence. This includes researching the local market, evaluating the property's condition, and analyzing the potential return on your investment. It's also important to consider factors such as school districts, crime rates, and access to amenities, as these can and will impact your property's rental demand and its long-term appreciation potential. Let's talk about some financing options. When investing in out-of-state real estate, you'll need to explore various financing options. Traditional mortgages, commercial mortgages, private money lenders are all viable options for financing your investment. And be sure to research and compare different lenders to find the best financing option for your specific needs. Tax implications. Another critical aspect of out-of-state real estate investing is understanding the tax implications. Every state has its own set of tax laws, and it's essential to be familiar with them to avoid any surprises down the line. Property taxes, income taxes, capital gains taxes can all have a significant impact on your investment's profitability, and you'll want to consult with a tax professional who's familiar with the tax laws in the state you're investing in to ensure you're making the most of your investment while staying compliant with local regulations. There's also some insurance considerations when investing in out-of-state real estate, and it's essential to have the appropriate insurance coverage in place. This includes landlord insurance, which covers property damage, liability, and potential loss of rental income. And be sure to research insurance providers in your chosen market and compare policies to ensure you have adequate coverage for your investment. You may also want to consider additional coverage such as flood insurance, depending on the location and risk factors of the property. Long distance property management. One of the most significant challenges of investing in real estate out of state is managing the property from a distance. Hiring a reliable property management company is crucial to the success of your investment. They will handle tenant screening, rent collection, maintenance, and repairs, ensuring your property remains in good condition and is producing a consistent cash flow. Take the time to research and interview property management companies in your target market to find the best fit for your needs. Let's talk a little bit about diversification. Investing in out-of-state real estate can also help you diversify your investment portfolio. By owning properties in various markets, you can reduce the risk associated with local economic downturns or natural disasters. Diversification can also provide a level of stability to your investment portfolio, as less likely that all your properties will be negatively affected by the same event. You also need an exit strategy. It's essential to have an exit strategy in place before investing in out-of-state real estate. Whether you plan to sell the property in the future, pass it on to your heirs, it's important to have a clear plan for how and when you'll exit the investment. This may include refinancing, selling the property, or holding onto it for the long term. By having an exit strategy in place, you can ensure that your investment aligns with your financial goals and risk tolerance. Now let's wrap this up. Investing in out-of-state real estate can be a great way to grow your investment portfolio and generate passive income. However, it's essential to do your research, understand the pros and cons, and have a solid strategy in place before giving in. By taking the time to educate yourself and build a reliable team, you can successfully navigate the world of out-of-state real estate investing and achieve your financial goals. Thank you for watching this video on buying a home. If you liked it, hit the like button so we'll know that you enjoyed it. If you have any questions, leave them in the comment section below and I'll be sure to answer every one. And don't forget to subscribe and hit the bell so you never miss an episode. Take care and have a great day.